Welcome back, everyone, to the Mortgage Heroes Weekly Podcast Show. I'm Andy.
I'm Brian.
And I'm Lonesome Mike.
Yeah, Lonesome. I love it. The name's going to stick. I like it. Actually, it fits you well. Let's loan some more money.
Yeah, let's do it.
Today, guys, we got to cover a couple topics. We got more unmarried couples are buying homes together. What to know before you do that. Mortgage demand dropping to a 27-year low as interest rates pull back. Mortgage rate tipping point. Homeowners say roughly 5% is a magic number to move. A very interesting conversation about that one. And then housing market predictions, the forecast for the next 5 years. Let's go right from the top. We're just going to go in order again today. We got more unmarried couples are buying homes together. What to know before you do. This comes from CNBC. And that unmarried couples make up 18% of all first-time home buyers for the first time. And this is up from 4% in 1985.
Well, it doesn't get any more creative than that. I mean, finding creative solutions, finding creative situations. I mean, that right there nails it right there perfectly. And what I like about it, I mean, it's just another form of house hacking. And I mean, you're already living with the person, maybe renting a place. You guys maybe both have pretty good salaries. I think this is a very good example, and I think it's very awesome that people are doing this because A, it lets you get into a house, build some equity, know what it is to have the responsibility. 2, it lets you know if you even like living with this person on a long-term commitment. So it's like killing two birds with one stone.
Yeah. And what's funny is I actually wrote down further in the notes, I'm like, Brian's been talking about this for weeks.
I'm like, right off the bat, it sounds like ding, 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 ding.
It says almost half unmarried. So 46% made financial sacrifices, including picking up secondary jobs to finance their purchase. And this is exactly the house hacking you've been talking about in a number of different settings, off and on camera and off camera. But this is that exact same thing where people are making those sacrifices, doing the extra thing, or coming up with creative ways to get into housing. Just so you're not jealous, I want to let you know on camera, Mikey did offer and extend to me to buy a house together before you did. So I'm going to have to go and qualify with him first.
Sorry about that.
All right, no worries. Can I do you guys a Linda?
Yes. You can leave it alone. So, Mikey, talk to me. You just had a birthday recently. So is this something that people in your age category are actually considering? I know the numbers are saying one thing, but tell me what's happening in the circles of your friendships and the people you're hanging out with. Are they talking about the same thing too?
Yeah, so I actually do know a few couples who are unmarried that have, brought this to my attention. Hey, we want to possibly purchase together. And the way I see it, it's no different than, just bringing an extra co-borrower onto your file to, maybe qualify for more, just have more income, maybe better credit, things like that. So, I mean, to me, it's no different.
Yeah. One of the things I know that this article talks about is first of all, they're talking about this combined average income that they're using of this survey. And they were saying that the average combined income together was $72,500. My initial note was not in California.
Where?
I mean, that does not fly. That does not correlate with what we know our affordability indexes here in California. Yeah. But obviously, I think, obviously in other places, this is probably going to do. But there are some things I think people need to be considerate of when doing this. And this jumped out at me, was that there are often no legal protections they can fall back on. And if one person decides to leave, the other can be saddled with the entire mortgage and may not be able to afford it. This makes me think of credit problems and having lates on your credit, and then also maybe being unable to afford it if that doesn't really work or dissolves.
So one counter argument that I had for that is that I feel that there's more financial solutions when you buy and you're not married than when you're married. Because when you're married, now you have to either split the equity, sell the house. Maybe you can't even get your profits back because you got a short sale or whatever the reason may be. But when you rent it with somebody else, you guys have the flexibility of having certain agreements put in place beforehand to know, hey, if anything ever hits the fan, this is what we already agreed to before we took the responsibility to make sure that if this situation arises, we already are protected.
So you'd be wagering that, let's say you did this with somebody else and that person said, hey, I got to bail. I don't want to do this no more. You're wagering that you'd be able to fill that spot with a stranger or someone else who'd be looking to also have you as a co-owner or a co-inhabitant?
That, or you can rent the house out if it makes sense. You could turn it to short-term rental. I feel like you could do a lot more with the situation than divorcing, because if you go to divorce, it does cost you to get into court.
Yeah, I'm not saying in the married situation. I'm saying in two unmarried people that own a house. Let's say you and I both own this house. And I'm like, Brian, I'm out of here. Now you're saddled with the mortgage like the article's talking about. Then you're saying you have confidence that you could either rent out the remainder of the house that now I was occupying, but I'm not, or you could just flee altogether and just make the entire thing into an investment.
Yes.
Yeah. Now, I know one of the challenges that comes up with this is title. I know one of the other things that came up in the article too is well, hold on, if you're both on title, well, now one person might have bailed, but you're still sharing that responsibility and that ownership. And again, back to the credit situation, if I default on you or I stop paying, that'll hurt me because I'm on credit, but that's going to hurt you too.
Yeah, of course.
So what do we do about that? What are your suggestions suggestions, guys.
Yeah, so I'm actually glad you brought that up, Andy, because I did want to ask you guys, just to address your point of maybe there being credit issues if one person falls out, is what do you guys think about, maybe going into title with right of survivorship, ownership is equal, tenancy in common? What's your take on that?
I think it comes down to the commitment of the friendship or the relationship. If it is, I understand people buy houses because they're going to get the house before they get married, and some people forego actually having a wedding and they just put that money towards having a house. So I've seen that in my own personal experience as well. So I think it really comes down to the reason and what really the future is forecasted to be, and if that is also a house you're going to stay in permanently, or you're saying 3 to 5 years, let's live here, and then as a group, the 2 of us or 3 of us will then convert it into an investment that we just hold in long term.
So
all that changes titling.
I had clients that did exactly just that. They bought back in a couple years ago, and then basically what they wanted to do is basically get into their job so that they could, grow that income over time, and then now they're able to turn that property that they bought into a rental, or take that equity and be able to then get a bigger house now that they have higher income. So I think it's very beneficial, but it really just comes down to if you trust the person and that it's not going to go sideways.
Yeah, I think intention means a lot, and also having some. I think this is probably one of the best things to do if someone's actually considering this, having this kind of conversation and go, okay, what is it we're doing here? What's the commitment? What's the time frame? What are our exit strategies if it doesn't work? What happens if, look, as a married man, I have to have this conversation with my wife in the sense of what happens if I die and the income goes away? What happens if you die and the income goes away? That matters to that surviving person, married or unmarried. And
definitely.
It's kind of sucks to say it that callously. I'm talking about it so casually, but it is something you have to consider, especially if you have kids and that kind of thing.
Absolutely.
But in this situation, the same kind of rule applies. If that just happens, what would help provide provision to the remaining person to be able to maintain ownership of the house? So I think that's something we got to think about. And they gave a couple suggestions here on things that should be considered by unmarried couples before buying a property. One of them was, maybe tapping into retirement accounts for down payment. I'm not a financial planner, so I don't know about that. You got the traditional IRA, Roth IRA, 401k stuff, and those have early withdrawal penalties in some cases. They have some tax consequences in others. I'm not going to get into that. We're not CPAs, and we don't do that. We got to review credit reports. You got to keep the credit activity low, and then save money. Save money somehow in order to make sure that for those rainy days or for those maybe those unthought of circumstances that occur, then the house is going to be in good standing. It doesn't go into default.
Yeah, and actually, guys, I was looking at it and it says save money in a high yield savings account. That actually caught my attention because I have one, and so anytime, whatever's in there right now, it grows at 5% a year, which is pretty high for that, to be honest. So that stood out as a really easy option for me too.
Yeah, and that's something we haven't talked about on the show a lot because we don't really interact with it here. It's not something we sell or we pitch,
Right.
But it actually is a positive outcome and consequence of the Fed.
It's a great hedge, as we're seeing.
Took advantage of it.
Yes, the CDs and the savings accounts are the returns are pretty okay.
They want your money.
Opened it at the right time.
Yeah, and depending on how you measure inflation, the current way or the old way, you may actually be making more in those types of accounts than inflation is costing you. So we can talk about that later, but I'm glad you brought that up, Mikey. So snapshot judgment, good idea, bad idea?
Purchasing with someone you're not married to?
Yeah, good idea, bad idea. Is there more upside or downside? What do you think?
Based off my experience, I'll say downside.
Okay, what do you think? Upside, downside?
I'm going to say it's a case by case.
Okay.
Case by case. If everything checks off and you're able to come to a mutual agreement, I think it may be a good situation because of the fact, like me, if I have another family that I want to live with, just to be able to, get together, save up some money, cool, we could do that. But I think it just depends on the circumstance.
I think it's upside when there are commitments already made that go down the road towards we're being married, we have a family, and we're already doing life together in that path. I definitely think it's downside when it comes to just an idea on a Saturday night that sounds good over a barbecue, and you try to go to do a loan app on Monday. That's the downside, and I think we should end with that.
Well, at least we all got a different perspective here.
All right, guys. So mortgage demand drops to 27-year low as interest rates pull back. I'm going to right off the top say pull back like barely. Okay, let's not get over our skis too far here. They're talking about from 7.31 to 7.21.
Drastic change there.
$3.
Go run and tell everybody right now. No. But here's the deal. We got mortgage application falling last week. The Mortgage Bankers Association, even on their seasonally adjusted index, is saying we have less applications coming to the market. I mean, look, we know this. We're not going to escape this. There's industry-wide this is happening, so we're no different than anybody else is in that sense. But, what would you say about mortgage demand being into a 27-year low? Here we are again talking about in the way back machine. This is back in the 90s now. We're referencing those times.
Well, I mean, it's kind of like the conversation we had last week, right? I mean, that's 27 years ago. It's how relevant is that now?
That's older than you.
No, it is. That's why I think
right around my age.
How relevant is that now in 2023?
Yeah, and
is it?
And relevance is a great question, and it makes me cautious about these kinds of measurements because we're just seeing more and more of these. We keep seeing measurements that are compared to 2008 or 2000 .com bubble, pre 9/11, and then pre housing rise, and then we see this whole interest rates aren't that high compared to the 80s. It's like, yeah, but houses were 60 grand.
So yeah, it doesn't matter.
I started to cut off. No, I feel like what they're doing is slowly conditioning us to let us know that this is going to be the new norm. Like 7, 8. Oh, wait, some days will drop, but 7, 8. And they keep pushing that and pushing that. Last week, we spoke about the same thing, 8% rates everywhere. And now they're saying 7, but it doesn't fall anywhere lower than that range. And then they do tell you like, but maybe in 2024, we might be seeing 5% by second quarter. But yeah, they also said that by 2023, at this time, we'd be in that range.
Mm-hmm.
Right. And that's exactly what I wrote here. And I have a funny correlation for you guys because Mikey, you're super fit and you'll understand this. You're going to laugh at me when I tell you this, but I'm going to read this from the article first. Mortgage applications declined to the lowest level since December 1996, despite a drop in mortgage rates. Rates remain more than a full percentage higher than a year ago. Now, two things. First of all, 1996 was a long time ago, so that's not relevant to a lot of people in your age category. You two guys. And a lot of people that we talked to, the majority of our clients did not own houses in 1996. Yep. Some of them did, but a lot of them didn't. And also, again, in 1996, houses were nowhere near the price that they are now. Again, we're talking about a long time ago. And remember, at this time, everyone was projecting that we would see like rates at 5.5 by this time and by the end of 2023, and that is not on the horizon.
No.
And I think it is disingenuous to say mortgage rates declined, and they're like, even though there's been a drop in mortgage rates. Now here's my correlation. If I weigh myself today and I go, Mikey, I'm 200 pounds. Mm-hmm. And then tomorrow I weigh myself and I go, Mikey, week over week, I had a drop in weight. I weigh 199 pounds. You'd be like, who cares? That's essentially the equivalent of what we're talking about here. Yeah. 7.3 to 7.2, like, come on. That's not, no one's coming off the fence.
It's not a noticeable difference.
No one's moving out of their houses because rates dropped that much. The house is not going on the market.
How many calls did you guys field last week? Because people were like, hey, there was a 1/10 of a change in the rate.
No, not at all.
I actually got so many, guys.
Yeah. Yeah, I don't think that's going to do it. I mean, it's kind of the nerve-wracking part because low inventory is low inventory. We have elevated mortgage rates, and these are just the accepted talking points at this point in the game. These are just the accepted talking points, and when are we going to call a spade a spade?
I feel like it took long enough for us to start seeing data like this that's just very brutally honest. That's just talking about what we've been saying for months now, and it goes to what I said. It's conditioning people to say, hey, this is the new norm. This is what you can expect, and yeah, we might give you a little bit of hope, but it's just so that we can continue giving you what's really going to happen.
And we did a show called "Is This the New Normal?" a couple weeks ago. Actually, it's not even a couple weeks ago. It's a couple months ago now. It was episode 29. Mm-hmm. So almost 10 episodes ago, we already did a show called "Is This the New Normal?" back then. That was in July. Yeah. So now here we are in the middle of September, and it's like
it seems like it is. Yeah.
I think we are at the new normal. Hey, you guys remember when they started to use the word transitory? Where'd that go?
Where's transitory?
Where's that
I haven't
word?
Heard that since like 2 years ago.
Yeah. Interesting, huh? Yeah, and I see less and less of the word soft landing now because I think it's less and less of an outcome. Yeah.
Well, that's what I also feel, that they'll state one thing but then get away with it and bring out a new thing to focus on, and then we completely forget about what they said over here because now the new hope's here.
Yeah, and the inflation information that came out last week, you guys, was basically a confirmation that we have reinflation happening. Even if it is minimal, it's reinflating, not deflating, which again goes against the Fed's goal and their stated goal. So this is the new normal. I'm putting a stamp on it. New normal.
And I'm agreeing with it.
I agree.
Okay, guys, mortgage rate tipping point. Homeowners say roughly 5% is the magic number in order to move, but then in the same article, they reference the 5.5 mark a couple of times. So, Brian, you've mentioned golden handcuffs, and that's brought up in here. And, I mean, look, right out the door, they're saying nearly 82% of homeowners feel locked in by their existing low-rate mortgage, according to data from Realtor.com.
Well, Andy, actually, before we go even farther, I want to ask Brian, isn't it kind of funny how they say 5% is a new magic number, but maybe back in January, if you quoted 5%, someone might be like, well, why? Why can't I get 4.5? Why can't I get 4.25? It's like, look how much the market has changed in just 9 months.
But
It's
look
ridiculous.
how much they're conditioning people, though. They're telling them this rate. So later on, when they do ask you, like, they know what the rates are. They're seeing it everywhere. And I just feel that that's what we need more, so people can really understand the climate of the real estate market and really make their assumptions or their goals based off the real numbers and not just stuff that they got told in conversation or is just lack data from that's not accurate.
Yeah, and this is the number that they were saying we would be looking at the end of 2023, which we will not be looking at the end of 2023. I mean, look, to go from where we're at now in this 7.25, let's just call it 7.25 for the purpose of our conversation today. Let's say we're 7.25 on the average, and then we got to get to 5.5. Like, that means that something really bad happened between now and the end of 2023 that would cause that to happen.
Yeah,
So I've been hearing a lot in discussion a black swan event. I've been hearing something that if only this happened, this is the only way that things could magically, change, or we might have to step in and lower rates. So that's something that I'm not saying is going to happen, but I have been paying close attention to because I've heard it from multiple news sources that are pretty credible, and I'm just interested, like, okay, is there something in there?
So let me ask you the question. In referencing Black Swan references a type of event that would occur. Which types of events are they suggesting might be the Black Swan?
I mean, the pandemic.
A miracle.
Well, that's yes.
I didn't want to use the P word.
I guess let me rephrase it. Economically, what would be an example of a Black Swan event that might undermine or compromise the rest of the system?
Possibly huge, like, job losses.
Job losses, okay, that's
like
a good
major job losses where people honestly can't pay their bills, and now it's just more than just the unemployment rate completely goes up.
Yeah, student loan debt I think is not being considered. I know that's a very specific one. It's a bit more nuanced.
Auto loan debt.
Auto loan debt, and I don't think, and again, auto loans and student loan debt are a mix of probably what companies are, lending out, right? It's not just, and I mean, there are cases where that is all I do, I just lend money for this or money for that, and there's we lend across a lot of things. So I think
consumer credit in general is
there's variety of risk depending on who it is that's holding all that debt. That's an issue. I think, I mean, on the long view, I'm looking at stuff like BRICS and the emergence of new baskets of currency that are undermining the U.S. dollar long term. And just as a caveat for all you guys watching, the U.S. dollar is connected to way too many things to just turn it off with the flip of a switch. That's not going to happen. But they are already working towards other alternatives to have economy exchange between other countries that don't include our dollar. So those are some of my ideas for Black Swan. Massive unemployment, of course, would potentially threaten housing. But again, there's equity. So people could sell and just get out from underneath whatever their financial challenges are. If they have $100,000, $200,000, $300,000, $400,000 of equity, problem solved. At least in the moment, not long term. So
makes sense.
What do you think, Mikey? What would be a Black Swan event you'd be looking for?
Yeah, in my opinion, to be honest, we need more unemployment. People need to stop spending. That's literally the only way we're gonna see that.
Brutally honest.
Like just straight up for us to see a 5.5. I mean, even by Q2 in 2024, I think we would need a miracle, right?
It does seem like it's far enough away on the horizon, but I have to remind myself, like, we're here in September of 2023 and they started rate hiking in March of 22. So, here we are, what is that, 17 or 18 months, whatever, 17, 18 months beyond when they started this. So I can't honestly say we're going to be back to anywhere the normal, if you will,
anytime soon.
In less than 18 months. I mean, that'd be quite the boomerang, but
I agree.
At least in this article, they're talking about it being unlikely that rates are going to drop anytime soon. I think it's a little bit of a falsehood that homeowners would be nearly twice as willing to sell their house if rates were at 5%. Willingness has a lot to do with the money and the cost, but also life circumstances and what's going on. So, I think that's a little bit of leveraging the point in that sense. So, What else, Brian? What do you got from this one?
So for me, it was about the payment. So when they said that they wanted to come down to that like 5%, so I did just a little example based off, 720 credit score, 20% down on a $700K purchase, and at a 7.375, not quoting, just principal and interest was $3,867. That's a difference of, if we go down to 5%, $861, and your payment would be $3,006.
So you're saying it's $861 more expensive now than it would be if it was at 5%.
Yes.
For how much to borrow? How much?
$700,000, 20% down, 140. So you're
a 560 loan.
560 loan, yeah.
Wow. So on 560,000, you would be at 3867
at a 7.375, which is more or less average of what the rates are at right now. And if it comes down to 5%, which is the golden number, $3,006 for your principal and interest.
Wow, that's a pretty big. I mean, that's a
and
significant difference.
What was the loan amount one more time? You said 560.
560.
Yeah.
560.
Jeez.
Yeah. Well, I know that this has like an inverse kind of relationship with listings. Well, not inverse. It's kind of a direct relationship. They're basically saying this is the high rates are incentivizing people to hunker down and do this whole golden handcuff thing. Like, oh, I'm handcuffed to this 3.5. Like, boo-hoo.
Dang it. Oh, my God. My house is full of equity.
I had this, like, maybe it's a snarky moment or whatever. I was reading that they had interviewed this grandpa, and he was basically saying, like, yeah, if rates were lower, I'd move to be closer to my grandkids. Like, sorry, grandkids. Grandpa can't spend the rest of his life with you because rates are too high.
Yeah, I noticed that, too.
Basically.
I was like, yikes. Maybe that's just me. And okay, so the other thing too, again, going back to referencing things of the Wayback Machine, between 1978 and 1981, mortgage rates similarly doubled from around 9% to more than 18%. And here we go again with these 40-year-old references that are only relatable to, a shrinking population, if you will. And again, like the house is maybe only $70,000. So fine, you got a 13% interest rate on $70,000. I know proportionally, like, well, but money was cheaper, things were less expensive, we didn't have as much inflation. That is also true. I understand that. But again, all things being equal, if you will, even on today's dollar compared to that dollar, the housing expense is way less affordable now than it was back then.
No, 100%. I mean, and these numbers, I feel they're not equal. They're not equivalent, and they're definitely not equal. I mean, it's a comparison. But at the same time, like you said, cost of living is way different, completely different situations. So many different things are happening in this life that I don't feel this is accurate for people to even be able to compare it to, because we're living in complete different times.
Yeah.
There was a reference that said, okay, LeBron James now, if he played back then in the NBA, he'd be the best player. But if the best player back then played in this world, in this type of environment, they wouldn't be able to compete because it's different times.
Yeah. The game has changed.
The game has changed.
Yeah.
There you go.
The game has changed. The game has changed.
Yeah. And Andy, I mean, I know this is from 1980, but even just going back to the early 2000s, for example, where I live right now, the community was built around 2005, I think. And so a lot of my neighbors, they moved in 2005, and they tell me, how cheap their housing payment is, this and that. And all I can think is, geez, like if they try to buy a house like this now, they'd be living in a 1-bedroom condo for that mortgage payment. It's crazy. And,
and I can go all the way back to 1987. My folks bought a house in Bonita in 1987 for $173,000. And that was high. That was really high at the time. And the rate was like 13%. But, they kept that house for nearly 20 years and then sold it for $750,000. And at that point, of course, rates were a lot lower, and they were actually in the fives back when they sold it in 2007. But you're talking about $173,000 compared to $750,000. That's quite the equity gain. But again, there's reference point for you. Like, yeah, it might have seemed hard. That mortgage payment was hard for them in the beginning, but over the course of time, it was easier and easier. They made more money. Their loan balance went down. They refinanced when rates went down. So they made the most of it, and they did it for long term.
I think a counter argument to that is that everybody nowadays wants everything quick, instantly, and right now.
Yeah,
I feel before people were more patient. They'd be able to save up. They didn't want everything to happen yesterday. Whereas now, thanks to everything happening in instant, you have this where, hey, I want to sell my house the next following year because equity's up. No, what if you hold on to it for 5-10 years, and then now you can actually have a significant growth?
And I think patience and commitment go hand in hand in this 100%. Case, because it's the patience to wait and it's the commitment to see it through. Because I would say it required both of them at that time. It wasn't just economically they had to stay there, and they weren't handcuffed necessarily. That's just the house that they committed to raise my sister and I in, which they did.
And I feel the values have also changed. Therefore, the style of buying and the way that we consume things has also altered the way that we go out and buy or look at certain financial situations that we make.
Well, and back to the top of the show, we're talking about non-married people who are buying houses together. That's that exact point. So. All right, guys, housing market predictions. This is from Yahoo Finance. Housing market predictions, the forecast for the next 5 years. There's a lot in this. I don't know where you guys want to start, but they're talking about inventory, days on market, homes sold. We're talking about price predictions. We're talking about what people can do over the course of the next couple of years. Brian, kick us off.
All right, so I'm going to go ahead and address the big elephant in the room, and that's will the market crash? And I feel everybody wants to know this. And one thing that Yoon said that stood out to me was that market crashes happens when there's a surplus of houses. And if you know anything about the current real estate market, we're at a shortage by a lot. So that right there just lets me know that there is, chances that it isn't going to crash because of all the placeholders that we have in place to be able to uphold all that if it happens, if shit hits the fan. We have equity in houses that'll be able to go ahead and, take care of a lot of the debts if they need to. But I don't see the housing market crashing because of the fact that houses are going to crash. There's none for sale.
Yeah. And again, I think if people are finding themselves in financial duress, they have the choice of selling if they have equity. Yeah. I mean, I think you will see it was just a couple shows ago, we were talking about delinquencies being at their 38-year low. That's for a reason. It's because those payments are easy to make. They're lower. We refinance half the planet like we keep joking about, but there's legitimacy to that. I mean, our two top funding years in the mortgage industry were 2020 and 2021 for total volume of loans refinanced, and they were also at the trough of when we've historically had fixed rate loans for 30 years.
Artificial.
This article actually references that within 2 years they think we'll be back at 5.5 to 6, and that possibly by the middle of 2024, to Mikey's point, the quarter 2 2024, that we'll get back to 6%. So anyone who's looking at the next 3 months, 6 months, 9 months, take note of that, and then also prepare and plan for getting through 2024 and looking into 2025. If you're going to be purchasing at the 7, you're looking to refinance at the 6.5, 6, 5.5. You're going to need to plan for 18, 24, maybe 36 months on the long end in order to do that, and then eventually come back to save some money.
No, that's right in coordination with, I feel, what everybody should be doing right now. And I honestly feel that there's going to be a lot more creativity in certain products for, financing, like for business owners, for, self-employed borrowers. Like ARMs, I think, will be a little bit more popular, bank statement loans. And the reason being is because if you're able to get into something right now, weather it out, and then refinance back to a traditional loan down the line when, in 2, maybe 3 years tops when rates come down, then you'll be able to still reap the benefits of everything. Because as we see, houses aren't going to decline crazy or crash for that matter. And even if there's a 5, 10, 15% correction, there's still enough equity built into the houses to be able to withhold that and still make a good enough, buck on your investment. So I feel that there's still a lot of upside for prices. They won't drop. They'll maintain and continuously go up because of the fact that there isn't any houses and they're not building anytime soon. If you guys been paying attention to builders, they're staying steady. So I don't know.
And that dips into a conversation we had last time, which was, at what point do the people sitting in cash on the sidelines jump in the game? Mm-hmm. Is it when they see a 10% correction or a 10% haircut or 15%? And how they jockey with one another to try to get in before the next guy who's trying to get a deal?
Well, guys, here's the way I see it. I mean, because I feel like, maybe I bring a little bit more of a consumer's perspective just because, at the end of the day, you guys have more experience than me. But the way I see it is what happens every time something is bad in the market, like right now. It corrects itself. The market goes back to normal. So if we're looking 5 years ahead in the future, by that point, I feel, we can expect a corrected market and things kind of back to normal as well.
Yeah. On what time frame? Did you say about 5 years?
Well, I'm just saying referencing 5 years just because, that's the article we're talking about.
Yeah.
But it could be sooner, 2, 3 years maybe.
But I feel like, look at it. If we do start bringing rates down, what's going to happen right away? Inflation, spending, and everything just goes right back to where we're at. So saying 5 years, I feel is, in line because of the fact that we do need to see enough time, read enough data to really make the prediction or make the decision that, hey, this is, I think, our time to basically shut it down.
Yeah.
And until that happens, I feel we're still going to be in the same predicament.
So the article is talking about this 5-year window, but let's take our personal take right here. It's like when do you individually think that we'll return to what we would traditionally call a buyer's market, where buyers are back in the market, they're off the fence, and you see buying frenzy? What would you say that's going to be? What year would you guess?
I'm gonna go out on a limb here and say Q4 2024.
Oh, that was specific.
I'm saying by Q4 2024, it's possible we can maybe be at that 5% golden mark.
Brian, what do you think? When do you think a buyer's market returns?
I feel a buyer's market returns once unemployment goes up and people start selling their houses. I can't give a specific time because we still haven't seen softening in the job labor market. But once we do see a huge spike in unemployment, then I can see a lot of buyers jumping into the market because there's going to be a lot more houses for sale, therefore alleviating the prices of homes a little bit and giving people the opportunity to either get in with the lower rate or get in with lower prices.
Yeah, I think it's
what year did you think that was?
I didn't put a year.
No, he's not saying year. He's saying conditionally.
Yeah, so I'm going based off of data. Yeah,
you gave me a year, which is good. He gave me a condition, which is also good. So you think it's a condition of unemployment, and then there having to be more houses come to the market.
The reason being is because they've had said times, they've had said certain dates of when things were going to slow down, when things were going to happen, and then once we get there and the data doesn't correlate with what they're saying, then I'm like, okay, well now I believe the data more than what I believe their personal assumptions are. No disregard to what you said at all.
Yeah. It's okay, and I am going to give a time answer. Mine is 2025. Mine is 2025 because of how long it's taken for us to get this far for the Fed to address inflation.
Yeah.
I am honestly concerned about the reinflation, even if it's just a mild uptick. An uptick, number one. Number two, I honestly think that 2024 will be absolutely wild when it comes to whatever's happening with the election stuff. I think that's going to actually take a lot of people and go, hold on, let me just wait and see what happens. I'm not talking about buyers necessarily. I'm saying industries are going to go, hold on, let's see. And then now I know what I'm dealing with. Now I can return to the market. And at that same time, I think we will start to see the impacts of these elevated and held for longer higher Fed rates that will be impacting people on the personal level. I think buyers come back in 2025.
Okay. We'll see.
We all got different perspectives again.
All right. I like that.
No, yeah.
Okay. So, so there's other stuff in this article, guys. They had some tips for buying a home. Let's take us out on a high note today. Let's talk about these things. The first thing to mention is thinking about earning power. The second is decrease debt. Third is improve your credit score. And fourth is focus on your local area. Mikey, what's your opinion about this? Like, do you carry the same weight as the article does, and that these things are all equally important when planning?
I guess if I had to move it, I would move improve your credit score over decrease your debt. Because, of course, as we know, we have seen people with, quite some debt still being able to be in a good position to purchase. For the most part, I would agree, though. Of course, the first thing is going to be having earned income. I mean, do you even make enough income to qualify? The reason why I put credit over decrease your debt is because it's not 100%, but it kind of determines, what kind of rate you're going to get. And as far as decreasing your debt, once again, everyone's in a different situation. You might have more debt than other people, but, for your specific situation, it might be fine. So, but ideally, if you could decrease it, that'd just be better and have a lower monthly payment.
How about you, Brian?
I think for me, one that gets downplayed is focus on your local area. Everybody gets focused on what's happening, all over the place, through the media, through headlines, that you really forget to focus what's happening in your backyard. And I feel that's where, there's a lot of gems where you could learn how your certain neighborhoods are selling, what incentives there are in certain areas of the city. And I feel that's going to ultimately, bring more opportunities. And if you're able to have the right information, you're going to make the best decisions. But I feel understanding what your market is and how your market's performing, how houses are selling. Like, who cares what the national median is? Yeah. What's the median in your neighborhood that you want to buy at? Like, that's the type of information you should be looking at. The turnaround, how the community is performing, all that stuff you need to learn about your community, because the finance stuff will get taken care of, and if you have the finances, everything will be okay. But you got to make sure that where you're living at also goes along with what your goals are. So I feel that that's also as important as everything else.
Absolutely.
Yeah, that's good. I was listening to you and I was thinking, I actually changed my answer because what you guys were talking about, because what I was going to say was you got to make sure your employment and your savings are in place first. Like having cash reserves is good because for any situation, for any economic anomalies that might be happening. But when you mentioned the local market thing, it really kind of dawned on me that what my summary answer is: identify what gets you in versus what keeps you out. So whatever's going to get you in is what the things you need to work on, and what is going to keep you out are the things you have to attack and you have to manage and overcome. So if you have poor credit, it has to be credit first. If you have no job, it has to be job first. If it means you have zero savings, you have to have savings first. If you have to pay down debt, then you have to pay down that debt. So where are your threats and opportunities? And then approach it from that perspective, because everyone's situation can be different. Yep. And then local markets are economically going to help you either get in or keep you out. You might be able to get in a less costly area that's an hour and a half, 2 hours north of here and have a long commute. First is try to live in the city, but not able to be afford. That might be the difference between being a homeowner in San Diego or not, or in Temecula or not.
And Andy, can I challenge you with a question?
Yes, go. Let's do it.
So I know you said, prioritize it by the things that'll get you in and things that'll get you out. But with all things equal, what would you put them in order?
I would say decrease your debt. Yeah, because you have to have a job anyways, otherwise you're not getting a loan. Yeah. So the first functional thing you can do is actually decrease your debt. Yeah. It is always going to help you. It will never hurt you by decreasing your debt. But when you decrease your debt, note to everyone watching, do not close your credit lines. Keep them open because the history helps you and the zero balance helps you even more.
That's 100% right there.
I'm Brian Landeros, and I approve that message.
All right. Well, okay, guys. Well, let's wrap the show. Good talk today, guys. Really invigorating. I was really pleased with all the topics we had today. Great feedback and commitment and contributions. So, what was your favorite part of the show, Mikey?
Favorite part of the show? Well, as you know, this is only my second show. I feel like I'm getting a better hang of how the flow goes. So I'm feeling more comfortable doing the show, and I'm actually looking forward to doing the show next week as well.
Awesome. Good job.
Nice.
How about you, Brian? What favorite part of the show?
Big shouts out to the unmarried couples buying houses. If it makes sense, make sure that you utilize all your options, and it's a smart financial move if it makes sense for you. So I was very, very surprised at seeing that, and I feel it's going to be a theme that we continue to see, and not even just unmarried couples, like friends, family members, cousins, and best buddies. I think that's going to be a very good opportunity to be able to get into a house down the line, because if you know that, hey, in 5 years, if everything comes back to normal, you have to live in this house for 5 years, you could then sell, and both of you guys could split equity and then be in a financial space where now you guys could get your own houses. So I feel that there's a lot of power in that, and not just for unmarried couples, just for friends, family that want to be able to co-live together to get a better financial situation.
That's a good one. My takeaway today was the mortgage rate tipping point, knowing that people being surveyed are saying, hey, I'll actually consider moving if rates are at 5.5, maybe even 6. You could probably fudge into that high. But to me, that actually spells inventory, and that is the upstream problem we're having right now when it comes to getting people in the homes. We need more houses for them to choose from. We need people to be able to qualify, of course, but we need to have inventory for them to choose from. So I am optimistic that if we do, and when we do, get back into that kind of 5 to 6 range, you will see people come off the fence and they'll maybe loosen up those golden handcuffs a little bit. And put some inventory on the market. So that was my best takeaway from today. Thank you guys so much for being prepared for the show. Great conversation today. And thank you all for watching. Remember, if you're watching on YouTube, make sure you subscribe to the channel, turn on notifications so you get notified every time we release a brand new show. And if you're listening to us on Apple or Google, make sure you have direct download clicked on so that every time we post a new show, you hear it first. Thanks for watching, and we'll see you again next week.
See ya.
Peace.